Just a couple of decades ago, way before many of us were investing in the market or even old enough to drive a car, the stock market went through an incredible period of boom and bust that, to this day, remains one of the most incredible stories of our generation. From the start of the decade, from 1990 to the start of the year 2000 in March, the Nasdaq, which is an index of technology-focused companies, climbed over 1,000%. That's an increase of 10 times, meaning that if you had just $1,000 invested at the start of the decade, you would have had, at least on paper, $11,000. That's $10,000 of gains and your initial investment of $1,000. And that was all in just a short period of time. Investors were making a killing on the stock market, and almost every company that was tied to the technology sector was booming. Hang on though, remember the saying that what goes up must come down? The bigger they are, the harder they fall? Well, after that big run up and the creation of one of the biggest bubbles in the stock market we've ever seen, the bubble finally burst in March 2000, and over the next couple of years, the market would lose more than 75% of its total value, wiping out nearly all of the gains from the decade before. Now, 2022 has been a really terrible start to investors, and lots of people are saying that we're headed for a market crash or that we're already in one. The question is, are there any clues we can learn from the past to help guide us forward? Personally, like a lot of people, I've only really invested in good conditions, and we can't really even count 2020 as a crash. It was over so quickly. So let's rewind the clock together, look at what happened back in the 90s and see if there's any lessons that we can learn to help us move forward in this decade, because I've got a feeling that it's going to be one hell of a bumpy ride.
Internet stocks drove a powerful surge on Wall Street today.
At the heart of it. The 90s. I was only small back then, but it looked like a crazy ride for a lot of people. The world was mostly at peace, global GDP grew steadily, and new technology was bringing people together at a pace never seen before. Plenty of people were living it up, including the Wolf of Wall Street himself, selling penny stocks to unsuspecting victims who were promised high returns as seemingly everything was just going up. The biggest contributor to the dot-com bubble was the creation of a new technology that would connect people and businesses together in a way that the world had never seen before: the internet.
Imagine a world where every word ever written, every picture ever painted, and every film ever shot could be viewed instantly in your home via an information superhighway.
More importantly, it was all about the World Wide Web, in case some of you out there don't actually realise what the 3 W's mean in front of your website addresses. Realising businesses could use the internet to sell to customers almost anywhere in the world and how quickly they could grow their businesses, virtually every company wanted to make sure they had a presence online. Some of the world's largest companies today would enter into the world to start their journey. Jeff Bezos would found Amazon in 1994 and start selling books, and Pierre Omidyar would go on to create what would become eBay. Now, I have a lot of memories of this part, going onto the computer or one of the first laptops that my brother had and plugging ourselves into the phone line, making that connection, and then we were on. The only downside was that nobody else could use the phone in the house, and it would cost you money every minute. Some people will never even believe those words. At the time though, I wasn't paying the bill, so I ignored that and headed to play some games online. The good old days of playing Counter-Strike and playing Monopoly on games.com. Some of you will never understand the pain. Aside from the fun though, the beginnings of a bubble were starting to form as different events collided, causing the prices of stocks to rise. Interest rates was relatively low, inflation was under control, so money was relatively easy to come by, and brand new companies looking to get funding found that money just kept on coming. This part is sounding a little similar to 2021. Check this out. In the 1990s alone, there were more than 5,700 IPOs of companies. This would be more new companies who started to trade on the public markets than the next 2 decades combined and more. As soon as a new company hit the stock market and regular investors like you or me could buy into them, many of these new companies saw their prices rise massively. Some of the biggest success stories that didn't quite make it were Pets.com, eToys.com and TheGlobe.com. Looking back, TheGlobe.com, what looked to be an early style social media platform, had everything going for it. The company went public at $9 a share, but on the same day its share price would rise all the way up to $97, ending at a crazy $63.50. A rise of over 600% in a single day, making it the single largest gain to date ever. Nothing since has ever come close. Not long after, the company, like many others, would end up going bust, never to be seen again, after failing to find money to bail them out. You see, here was the problem, and it was a combination of things that happened. But in short, there was way too much speculation, too much hype, and too much money invested into companies that had business models doomed to fail.
Presumably the people that are in the public markets, they're buying fully baked companies, and these weren't in the oven for 10 minutes, these kind of things. They were not even close to being baked, and they were offering them up as cooked.
So many people got caught up in the hype machine of Wall Street. Companies changed their names to add a .com at the end, which would immediately make them more valuable. Retail investors from average investors like you and me, as well as institutional money from some of the largest private equity companies, were all looking for the next 10x stock. What really mattered though was that the share price no longer reflected the intrinsic value of the company. Way too much of the future earnings were baked in, and it was assumed they would grow a lot quicker and make a lot more money.
These online communities are great things for consumers. They allow every man his own website. On the other hand, as a commercial vehicle, it is a completely untested product. None of these companies make any money.
It was a giant house of cards built on nothing but hope and optimism that would inevitably fall. There were no profits to back this up. So one by one they fell. They ran out of money, thousands of people lost their jobs, company share prices fell through the floor, and hundreds of billions of dollars of value were wiped from the stock market. There were a few survivors though, but good luck if you would have managed to hold on to them. Amazon's share price fell from its highs, losing more than 90% of its value at one point. eBay survived as well, and let's not forget Cisco, one of the greatest performing stocks during the 1990s. Its share price has still not managed to get to its previous highs more than 2 decades later. Was there anyone we can point the finger at to blame, or any single event that's caused this to happen? No, I think it took a few different things to happen all at once, but clearly the bubble exposed the biggest weakness in the free market system: our own human nature and how easily we can get swept up in the excitement to make money fast. How does this compare to the current market conditions then? Are there any similarities? Well, if 2021 was anything to go by, then I think we experienced some of the same things. We saw a huge number of new companies hitting the stock market in IPOs. In fact, check this out. 2021 was actually a record in terms of a number of new companies who sold their shares to the public for the very first time. 951 new companies, many of which were brought to the market by SPACs, that's special purpose acquisition companies, and these companies were nothing more than shell companies who would sit on the stock market looking for companies to invest in to take public, and along the way take a healthy cut of the money, making lots of people very rich. Some of the biggest from 2021 included SoFi, the fintech brand, and Virgin Galactic, Richard Branson's attempt at space travel, which have both currently seen their share prices take a massive hit.
Oh, this is unbelievable. This is too unbelievable.
Although, don't worry about the owners of the SPACs, they got plenty rich. All of this extra money floating around the system was caused by the response from governments around the world to keep their economies afloat during that pandemic. US citizens were given stimulus checks directly into their hands, and other countries in the world paid people to stay at home with borrowed money. Central banks like the Federal Reserve in the United States purchased bonds and mortgages from the government in huge quantities, which is as close to printing money as you can get. US debt went from around $4 trillion to almost $9 trillion between March 2020 and now. What happened to all of this extra money in the system then? Well, you know the rest of the story already.
As your wage and your salary cannot increase and keep up with the pace of inflation, your purchasing power will be hurt.
Wage increases nationally were 5%. Phoenix wages were up 6.4%. Now that's, of course, not really keeping up with inflation.
People will be hurt a lot more.
More money going after the same amount of stuff creates inflation. It's just a simple game of supply and demand. And also, with millions of people locked up at home and with very little to do and spend their money on, the stock market became the place to play. Many people were caught up with companies who would change the way we work forever and take advantage of our more domestically based lives. Companies like Peloton stepped in to keep people fit at home, Zoom had a huge break where it was finally needed by almost every company in the world, and Amazon became the one-stop shop for consumers and businesses as everything else was locked down. The problem was that, eventually, the prices of the companies on the stock market was getting a little too hot, and just like the dot-com crash, the price of the company was no longer reflecting the underlying business.
And the momentum traders who crowded into their stocks during the dot-com era, they got eviscerated. Remember this phrase: the dot-com bulls were right about what the future would look like, but they were way too optimistic about the timing.
Many of the most popular stocks of the past couple of years made no profit and were based purely on their future potential. Just like in their own lives, there's only so long you can survive if you've got no job to bring in your income and you've got to pay your bills with credit cards. Many people assume that when a company had a great quarter and made lots of sales because they could sell to people who were at home, then this would just continue forever because the way we'd live and work would have changed forever. This assumption turned out to be very wrong. Making things worse were a few unforeseen events. Russia invaded Ukraine. This increased pressure on global supply chains that were already strained. The prices of energy kept rising as demand remained high, but supplies had not yet been increased quickly enough to meet the demand, and the power to raise that supply is in the hands of a very small number of countries. And finally, we're seeing a slowing of all of that extra money that was floating around before. The Federal Reserve in the US is looking to push ahead with what is called quantitative tightening. It's the opposite of quantitative easing, which is what they've done to provide the government with trillions of extra dollars to support the economy through the pandemic. During tightening, the Federal Reserve, chaired by Jerome Powell, will finally sell the assets on its balance sheet, basically all of the money that it provided to the government. And once this is done, that money that was created effectively disappears, so there will in theory be less dollars fighting for the same amount of goods and services. Let's not forget, we're also going to see a rise in interest rates too over the coming months, and this has an additional effect of making it more difficult for those newer businesses to borrow money. It will cost them a lot more and mean that any future earnings will be more challenging to get to. This leaves us with a simple conclusion then about what to do. If you're investing for the very long term and you're an index fund investor, then you stick with your plan and you keep buying. If anything, any kind of the dips or sell-offs are a huge opportunity to reduce your average cost in the market, and I've got no doubt that in hindsight, if you travel back to the stock market lows of 2020 if I gave you a time machine to buy more shares. The challenge is much greater for the stock pickers though, and this is a lot more difficult. As we've seen, even that great companies can fall quickly, and for those people, they'll need to ensure that they're highly confident about their picks and maintain their conviction, something I do only with a part of my portfolio, but still important nonetheless. As I said in my last video about the stock market crash, the important thing for newer people and most investors is to zoom out for the long-term view. Any drops we see now, even if we fall another 20 or 30%, will still just be a drop in the ocean and we'll hardly even see it on a long-term chart. If you're truly a long-term investor, see this as an opportunity, avoid the noise and keep calm. Do what's right for you, be careful, be patient and seek help if you need it. Remember, I am not your financial advisor. And with that said, if you're looking for a more in-depth look at what's going on in the stock market currently and some useful tips to survive a stock market crash, see the video I did here next. Otherwise, please drop me a like if you found the video useful, subscribe for many more, and as always, happy investing.